Hi everyone, welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. So in this show, what we do is we help people improve their financial acumen by being able to read financial statements in a better way. And we do that by taking on famous brands from around the world and analyzing their financial statements so that you can get better at reading those financial statements and drawing some analysis and conclusions from them. So today we're going to be looking at a very well-known brand, a British brand, Aston Martin, or actually in terms of its full company name, Aston Martin Lagonda Holdings PLC. Now this company and its products, especially its luxury sports cars, have been made famous by the James Bond films, and they've been around since 1913. Now, a few quick notes about this company to give you the context before we look at the financial statement, and then we also look at its share price as well. So stick around for that because you'll start to see the context behind the share price in the financial statements and to help you analyze any future statements. The company recently announced that it's issuing kind of a £576 million of rights issue to investors. And the reason why they're doing that is because they have a significant amount of debt that they are trying to get rid of. And we'll see some of that information in the financial statement, so stick around for that. The other thing to note as well is that recent half-year losses has been to the tune of 289 million. So this company is going through some tough times at the moment. Again, we're going to see some of that in the financial statements as well. The share price. Now, they floated in 2018. And if you'd invested back then, you'd be sitting on a loss of just over 96%. So not a small amount. If you'd invested a year ago, you'd be sitting on a loss of 79%. So they are going through some tough times. Shame because it's such a well-known luxury brand, but can they turn a corner? Well, we're going to be looking at the audited annual statement. So that is backward looking. And the share price is obviously, the investors and Wall Street's assessment of what this could look like in the future. But we're not going to analyze that for you. What we're going to be analyzing is just the financial statements, and you can use that as part of either your investment thesis, or if you're selling services or products to a company like Aston Martin, and you really want to look under the hood of its financials to see, what does this mean to your sales approach? So, Ted, let's share with our viewers what we have uncovered about this company and really help our viewers and listeners better analyze financial statements of companies like Aston Martin.
Good to see you, Moeed, and welcome back to all of our viewers. Well, welcome back to our subscribers. Welcome if you're new to the channel. Please don't forget to like, share, and subscribe. Obviously, if you're subscribing, you're going to receive notifications about future videos. And also you can request videos. So this is a request from, we've had two requests independently. David Best, Aston M, I'm guessing he's talking about Aston Martin, and Mohammed Iqbal have both requested that we have a look at Aston Martin. So if you have a request, you have a particular company you want to look at, you can send us a note. Now, we do get lots of requests, so we don't get a chance to do all of them, but if you do send me a request or send us a request, and also give me an explanation of why you're interested in the company, it's more likely to have a look. So welcome back, and let's have a look at their financial statements. So here are the financial statements, annual report and accounts for 2021. Now I know we're in 2022, but they haven't yet closed their 22 accounts. So we're still, looking at some fairly historical information here, but we can still find out a lot about the company. So this set of annual report and accounts will tell us all about the business, who they are, what they do, what their strategy is, who's in charge, what the experience of the board is, remuneration, corporate governance, etc., etc., etc. And you can read that to your heart's content by downloading it from their website. But I am going to whiz straight down to the numbers, and the numbers are on page 154, so you've got to go for quite a long way in order to find them. And we are looking at the year ended 31st of December 2021. So obviously 2022 is not going to be out until sometime in kind of mid 2023. So here are the numbers, and we are looking at the income statement, which is their trading account, and these guys are making sales of well, we're in millions, and we're in millions of pounds. So 1,000 million, that's a billion. So basically they sold £1 billion worth of cars. Now look at the previous year, that is a significant increase. So these guys were really struggling during lockdown. So lockdown comes down, people are not buying cars, maybe they're kind of fearful for the future, and maybe those luxury purchases they're going to be putting off. So 600 million, and that's up. That's an increase on the previous year of, nearly 80%. The cost of sales is the cost of actually, making the cars that they sell. So they're going to, if you're going to buy an Aston Martin, obviously Aston Martin has got to make it. They've got to buy the raw materials, and they've got to put those together. It's going to cost them £750 million to make it, which is about a 69–70% of the sales price, which leaves them with a gross profit of about 31%, significantly up from the previous year of 18%. But I think the 2020 is not really a comparative year, because I think there's some, obviously big issues there with COVID coming through. So gross profit is 343. That's this number here, and is really where the problem starts, because then they get into their what we call SG&A, the sales general administrative expenses, the costs of running the business, not making the cars but running Aston Martin, and you can see there that it is costing them about 420 million. That's those two numbers added together, which leaves them with an operating loss of 76 or nearly 80 million pounds. Okay, now a lot better than the previous year, where they made a loss of 323 million pounds. But you could argue that 2020 is a one-off, but 2021, hopefully we should have been leaving that pandemic behind us, and maybe people sort of going back out and buying those purchases that they deferred, yet these guys are still making a loss. And the problem here is then in this line here, this finance expense. So the finance expense is the cost of the debt. If you're running a business and you make a loss of 76 million and your interest on your debt is 174 million, you have a problem, because the banks are going to be unwilling to lend to you in the future. And therefore, when you go back, when the debt matures, you go back to them and you say, can I refinance? They'll say no, which means you've got to find the money to give back the principal. And we'll actually look at what the principal is. It'll be sitting on the balance sheet. And if you haven't got the cash to be able to repay the principal, then you've got to go to your shareholders. And if you go to your shareholders and they say, no, not interested, we've had enough of you, then the company goes bust effectively. And that's exactly what happened to Thomas Cook, if you want to sort of look at a comparative business, obviously not in the automotive sector. So these guys, have, a lot of headwinds, in front of them if they can't turn this around and start, great cars, absolutely fantastic car, a great mark. But the fact that the product is great doesn't mean that the company that sits behind the product is great. And so what we're looking at here is a set of numbers which is not really giving us a huge amount of confidence in the future of Aston Martin. I think it was Hemingway who said that companies go bust in two ways: very slowly and very quickly. Well, if Aston Martin is going bust, and I'm not saying that it is, but if it was going bust, it would be in the very slow stage at the moment. When it runs out of cash, that's when it's game over. So let's go and look at the balance sheet and see the financial strength of the business sitting behind those numbers. So first of all, we're looking here at the non-current assets. These are the things that we need to run the business. Interesting enough, by far the biggest number is their intangible assets. So this will either be goodwill or intellectual property rights. So probably going to be goodwill, which will have arisen on acquisition of other businesses. In fact, we might just go and have a look at note 12. It's such a big number, and really understand what is in there. So here we are looking at note 12, and we can see there is quite a lot of goodwill. There's the goodwill, which really is arises on acquisition of other companies. You can see they've invested a lot of money in their brand. So the brand has 300 million. You don't often see brands sitting on balance sheets. Auditors don't like that, because you don't know what it's worth. You think about some of the most valuable brands in the world, like Apple, for example, or Coca-Cola. The value of those brands do not sit on the balance sheet. They've got some IT, technology, software, their dealership network, software and other. This is quite interesting, this capitalized development cost. Not sure exactly what that relates to in terms of the development of what. Maybe that's facilities. I have no idea, but that is a big number, and I don't know if there's anything in the accounts. I haven't been through the kind of the detail to see exactly what that relates to. 1.6 billion of this capitalized development cost. So this capitalized and development cost, I'm not sure exactly what it relates to. Now, it's an intangible, you can't touch it. All I can think of is that they kind of it's a bit like, here's my guess, it's the cost of developing the production line to produce the end goods. So the production line itself, the physical kind of machinery will be plant machinery, that's a tangible, and then the cost of putting that together is your development, and has been capitalized. Now, this is a complete guess from me. I can't find anything. I may have missed it in the accounts, but if anybody has any insights into exactly what that relates to, that 1.6 billion, which is quite a big number when you think about it. It's the carrying value is nearly £1 billion out of a 1.3 billion of intangibles. That's the over 50% of our intangibles. I'm not sure exactly what that is, but let me put it this way. If you were to liquidate the company, I wouldn't expect to see it on eBay anytime soon. I don't think it's something which would be, it's very liquid, it's very easy to turn into cash, so to speak. Unlike, obviously, if you've got the brand, for example, will probably have will be of value to somebody somewhere. So there's the non-current assets. Property, plant and equipment looks pretty light to me, 355 million, suggesting a lot of it will be, I'm guessing would be outsourced. They'll kind of, they'll move it off their own balance sheet. So, they'll have suppliers who make the parts and then they kind of do the final assembly. Total non-current assets, about 2 billion, 1.974 billion, nearly 2 billion. Current assets, we've got the inventories, that's the work in progress, the finished goods of cars. Trade receivables, you'll notice that there's no kind of big trade receivables, suggesting that Aston Martin don't finance the sale of their cars. So we looked at BMW, I think, a while ago, and BMW very clearly, they lend the money to the individual to buy the BMW cars. These guys, if you want to buy an Aston Martin on finance, and you probably need to because they're pretty expensive, you're going to have to go to another bank. There'll be an arm's length relationship with a finance company who Aston Martin will work alongside. And here's their cash sitting on the balance sheet. So we wanted to see how much cash they had. They've got about 420 million in the bank. So, they've got cash in the bank, not a huge amount of cash for a company that is losing, it lost 410 million in 2020 and 190 million in 2021. So this suggests that, the day of reckoning is not a million miles away, so to speak. Here's their borrowings. So we can see the borrowings. Look at that, £1 billion sitting on the balance sheet, plus a little bit of short term. And this short term, they got to refinance. Have I got to refinance, or they got to give it back? And if you're sitting in the bank and you're looking at these accounts, you might be thinking, not sure I really want to be, refinancing that I'd actually like to get my money back. Trade and other payables, quite a big number there. So interestingly, trade and other payables, relatively large number in the current liabilities. Back of an envelope calculation, and I emphasize this is back of an envelope calculation, suggests that it takes them 320 days to pay their suppliers. So if you're a supplier to Aston Martin, be prepared for a lot of phone calls trying to get your money on your invoice. Now that would make sense to me, because these guys, they've got cash flow. It looks like they've got profitability issues. We'll look at the cash flow in a minute, but it looks like, they're resisting paying their suppliers in order to basically stay alive. So, there's a few alarm bells kind of ringing around these accounts. Nothing else really that kind of, that stands out, only that, if we look at how the company's been funded in the past, there's the amount that the shareholders have put in, and these guys, I mean, they've got retained losses. So they've been making losses in the past, and maybe the story is we're turning the corner. The James Bond brand, the kind of the aspirational aspect of Aston Martin, but the numbers just aren't following that storyline at the moment.
Should we talk about quickly the liquidity issue that seems to stand out as well? I don't think we covered that.
Yeah, no, you're absolutely right. So we should. So Moeed's absolutely right, and I missed that. So liquidity ratio. So what Moeed was just mentioning is this this current assets figure, which is here, the the 867 million pounds. These are basically assets which are things which are cash or going to become cash soon, and we can see their current liabilities that they have to pay soon on 905. So this is a very kind of rule of thumb. You want your current assets to be greater than your current liabilities. So the way we would interpret that, if we were to kind of look at the ratio, the liquidity ratio is about 0.96. that says for every £1 these guys owe and have to pay soon, they've got 96p either as cash or coming in as cash soon. Now some companies can operate at a kind of ratio below 1, but car companies traditionally are not one of them, and therefore that is an issue for these guys. There's kind of there's more alarm bells in terms of the liquidity. Now this potentially has an issue, because if you buy a car, you buy an Aston Martin with a 5-year warranty, company goes bust, your warranty is worthless. So this is relevant to people who are buying the product as well as people who are buying into the company. So thank you to Moeed for pointing for drawing my attention to that and pointing out that we've missed it. Movement in equity is really pretty irrelevant, because they're not paying any dividends for obvious reasons, and I can't see them paying dividends for a while. So let's look at the cash flow statement. Now the cash flow from operating activities, cash flow is positive, so that's good. We see here's the loss for the year negative, and we can see there's depreciation. So the depreciation is causing some of that loss, and obviously depreciation is a non-cash expense. Prior year, again, it was 200 million loss, cash loss. That was obviously an issue that was non-sustainable, but that was very much pandemic related. So these guys, they are generating cash, not a huge amount of cash, but they are generating some cash. And then they are using some of that cash for investment, and we can see here the acquisition, and a lot of that is sort of going into things like development costs, for example. So the interesting one is then how they're financing that business. So there's the interest that they're paying, so big old interest bill. Here we see the kind of the repayment of existing borrowings and proceeds from new borrowing. So this area here is kind of looking at the refinancing, suggesting that they are able to do some refinancing. So the banks are still open for business, and they are still having conversations. So these guys aren't in dire straits yet. I'm not sure exactly this inventory repurchase agreement. This is all about I think this is to do with their dealers. So they're selling money, they sell their cars to their dealers, and then they agree to rebuy, buy back any cars that the dealers can't sell. I think that's what that's to do with. So I'm not absolutely exactly sure how that all works, but really you can see that these guys, proceeds from new borrowings, that's a pretty scary number here. Proceeds from new borrowings in 2020, the proceeds, if we read these two numbers together, they raised 1.3 billion and they repaid $1 billion or 1.1 billion. So their debt went up by 200 million. And in this year, their debt has gone up by, nearly another 100 million, 80 million, for example. So the debt is going up. The debt is going up. The debt is not affordable. Interest rates are going up. These guys are making a loss. There's a can that's been kicked down the road, and it doesn't look like they're really addressing the underlying issue of profitability. So if you're own an Aston Martin, or if you own Aston Martin shares, you might be sitting there thinking, Ted, you haven't really painted a very particular nice picture for me, and I apologize about that if you're feeling a little bit unhappy. And you wouldn't be the only person. Here is the share price since they floated back in 2000, and I think it was 17 or 18 or something like that. And we can see it's been on a sustained downward march. You know, if you had invested at the opening, if you bought your shiny new Aston Martin, thought, what a great car, I'll buy the company, you'd be sitting on a very, very substantial loss. And even over the last year, we can see that the company has been going down and down and down. Now, no price to earnings ratio, obviously, because there are no earnings, no dividend yield, because there is no dividend. It's sitting at 145, and we might be sitting there thinking, well, Ted, you know, that's a bargain. It's about as low as it's ever been. Well, absolutely, but it can still go to zero. Whatever level the investment, the share price is, it can still go to zero. You can still lose all of your money. So if we look at that number, the market cap is what's that? That's a billion, just over a billion. So that's a billion on a net asset value of about 660. So there's still some inherent goodwill in there. So there's still, you know, if you remember the balance sheet, the equity in the business, and I'll just pull that up just to show you which number I am referring to, if I can do that. So if we go into the balance sheet and we look at the shareholders' equity, we're effectively saying that, you know, if you buy the company, there's the shareholders' equity, which is the same as the net assets, because the balance sheet balances. So the assets, the net assets, as the assets less the liabilities, is 660. So theoretically, I emphasize the word theoretically, if you were to put the company into liquidation, you'd end up with 660 billion. Would you pay $1 billion for something which is only worth on a book value 660 billion? Well, it's not making any money. So, you know, basically you're buying into a turnaround story. That's all I can see, is that, you know, this company has a, you know, we're going to be great again, we're going to make great cars, and we're going to make it a lot of profit on the back of that. But, you know, they haven't been doing that for a while. And, you know, for me personally, I'm not 100% convinced by that. So Moed, you know, as the Dragons would say, it's not for me and I'm not investing. You know, great cars, absolutely stunning cars, you know, big fan of them. I don't have one myself, slightly outside my price range. I don't have one myself, but I know that, you know, there's a very aspirational mark. Unfortunately, it looks like the company that sits behind the mark isn't quite as polished, should we say.
And there you have it. So, you know, we're sharing our opinions here, but the important part of these videos is to educate our listeners and viewers on how to read financial statements a lot better, how to more quickly and accurately draw insights and understanding about the businesses, whether that's to apply that for your investment or for your sales proposition or even for your general business acumen. So that's what we're doing here on this show. And, you know, as Ted said, if you have a company that you are really interested in analyzing financial statements of, you know, do please leave a note in the comment section to make your request and put some context behind that. The more information you share with us, the more we're able to identify things that you'll specifically be interested in. So as I said before, about 95% of the companies that we analyze are actually requests from our viewers. So do please put in your requests. So until the next video, don't forget to like, share, subscribe, and we'll see you in the next video. Thank you, Ted.
Catch you later, Moed.